Hello and welcome back to the Property Pilot. The rain has finally stopped, but I've got a spare 10 minutes, so I thought I'm going to do a video on interest only versus repayment mortgages. And this is a really important point, and we need to be confident on which both of these solutions are and when to actually use them. So to kick off, we'll go into the definitions. What is an interest only, what is a repayment mortgage? So an interest only mortgage is where you take out a mortgage, but you actually only pay back the interest itself. The capital part is non-existent, so all you're doing is paying back the interest. You'll never actually pay off that capital lump of the mortgage, and you don't intend to. And there's certain times when we choose to opt for an interest only mortgage, which I'll come on to very shortly. Whereas a repayment or a capital repayment mortgage is where you do both. So you pay back the capital and you pay back the interest at the same time. So the idea here is slowly over time you would have paid off your debt. Whereas with the interest only option, that debt just carries on for as long as possible until you've exited that debt. And again, we'll talk about options on how to exit that debt very shortly. So without further ado, most buy-to-let investors will opt for interest only mortgages. And there's several reasons why they do this. So firstly, this is the thing I love about it, is because you're on an interest only mortgage and you're not repaying the capital, your monthly repayments are less than it would be on a capital repayment mortgage. So what does that mean for a buy-to-let investor? Well, that means your mortgage is less, which means you're actually taking home more cash at the end of the month, which is great because in my opinion, property is all about cash flow. You need that monthly cash flow coming in. And once you've got a certain cash flow coming in month in, month out, you can quit your 9-to-5 job and you can do whatever you want to do and spend your days doing whatever you desire. So that's why a lot of buy-to-let investors opt for interest-only mortgages to maximize their cash flow. And there's a number of reasons, besides the obvious, obviously more cash, on why we do this. Obviously, it increases the cash flow, which is great, but it will also increase your return on investment by leveraging to a certain degree, depending on what that interest rate is. So if that interest rate is a fairly low or average interest rate, then it will most often than not increase your return on investment, because the opportunity cost here is, imagine the other option. You'd be putting in all your funds and you wouldn't be getting a mortgage. Let me use the other option. You're getting a mortgage, but it's a capital repayment option. So your monthly payments are higher, and that squeezes your profitability on an annual basis. And of course, your return on investment will therefore fall on an annual basis. So if you want a higher return on investment and you've got a good interest rate, then I consider interest only. Not only is it going to get you more cash, but it's going to increase your return on investment as a result, because you're netting more cash every single year. Now, another thing we need to think about with interest only mortgages is how we're going to exit this mortgage, because obviously we've got no intention to pay back this capital on the term itself. But how are we going to pay back this capital? We need to have a plan. We need to have an exit strategy. Now, some people like to hold properties forever, and their aim is to never sell, and that's their strategy, and that's fine. And to a certain extent, some of my properties I share that same belief. However, there's others where I have different exit strategies. So, for example, one exit strategy of an interest-only mortgage could be to actually sell the property. We're selling the property, and it's quite simple. Whatever we sell it for, minus what the balance of that mortgage is, and that's the profit that's left. So, for example, if let's say I'm using a real world example that's going through now, my portfolio. I bought a property for 140,000 in 2020, or was it 2019? One of those. 140,000. I got a 75% interest-only loan, which worked out £105,000 mortgage. I'm selling it at the moment for £200,000. So if you take £200,000 minus the outstanding balance on the mortgage, which is £105,000, my gross profit on that is £95,000. And that's one way of exiting an interest-only mortgage, or really any mortgage for that matter. So as long as we've got a plan to exit it, or as long as we've got a plan, that's great. Now, where an interest-only mortgage may not be ideal is if you're buying in areas that have very poor or even negative capital appreciation. And sometimes this is very hard to forecast. There will be some areas of the UK, when a recession comes, they're hit really bad, and the values in those areas will plummet. And obviously the last thing you want happening at being on an interest-only mortgage is having to put more capital in to provide for that, or any mortgage really for that matter, if the bank insists on maintaining that loan to value. So be careful when it comes to purchasing property. I'm not saying don't purchase in these areas, but just consider how you're financing those acquisitions. But yeah, as we've already mentioned, what I love using interest-only mortgages for is investing in areas that have, what I think anyway, will have a massive increase in capital appreciation, because I have no desire to actually to hold that property for the long term. And I know that I'm going to be selling this property, say, in 5 or 10 years, or maybe even as little as 2 years if I've got a really good deal. And I know by having that interest-only mortgage, within a short time time span, the risk of things changing drastically is somewhat reduced, and therefore I'm more confident of selling the property at a higher value within 2 years. Another reason why people like interest-only mortgages, and it relates to a point that I mentioned in a previous video, is that because the interest-only repayment on a monthly basis is less, you get more cash, it increases your return on investment, and that obviously gives you more cash to reinvest and further scale your property portfolio. So what I'm trying to say is here, interest-only mortgages will help you actually buy more properties in a shorter time span because you'll have more cash to fund property acquisitions, you have more cash for deposits. Now, there are some downsides, as I've already mentioned, to interest-only mortgages, and that's the kind of somewhat unexpected, recessions. We don't want to get caught with our pants down and having to, having to be forced to do something with the property, which is a big no-no. We never want to be in a position where we're forced to sell something, right? So, if you think there's going to be a recession coming up, well, don't just fix for 2 years, consider fixing for 5 years, and that will get you through that, and hopefully by then values will have picked back up again. And again, if you've made not even necessarily a mistake, sometimes recessions are very hard to predict. I mean, look at COVID, that was extremely difficult. No one could predict that. But if you're coming towards the end of your fixed term on your interest-only mortgage, and you're a bit nervous that the value of that property may be less than what it is now, well, actually act ahead. Build a slightly large cash buffer just in case you have to actually put cash in to get it to remortgage the property. So, if things aren't going to plan, the funds and the profits you're making from your rental on a monthly basis, bank them, put them in a 3 to 6 month contingency, and when the remortgage comes through, and if you need to actually put money in, that's where that money is going to come from. So obviously the lion's share of this video has been speaking about interest-only mortgages, and that's what I love interest-only mortgages. They're very close to my strategy that I undergo in terms of property acquisitions and developments. But we haven't really touched upon repayment mortgages, repayment mortgages are what most people do when they buy their own home that they live in. They repay the interest and they repay the capital, and as a result their monthly mortgage is increased. And this is because if you're buying your own home, lenders don't like you to be too old and still having a large debt, and that's why the aim is to slowly pay it off. And by the time you've reached retirement, there's no need for a mortgage, because if you want to get a mortgage around that time, there are less lenders in the market for that. So it's very common for people to purchase their own homes with just a standard repayment mortgage. However, saying that, there are some somewhat savvy investors who purchase their own homes using interest-only mortgages, and it's something I've explored a few times before. And the reason why I would suggest considering it is twofold. A, your monthly mortgage repayment will be less, which means you've got more money in your pocket every single month. But B, if you're buying in a great area for the long term, for a 5-10 year long term, and capital values increase, well, that is your exit strategy right there. Values are increasing 5% every year for 5 years, say, for example. Then that's a very safe exit on an interest-only mortgage. And especially if you're younger, if you're in your 20s or 30s, maybe you've got a bit more time to either accumulate funds for for a property that you're planned to reside in late in your mid to later life. Because what you don't want to be doing is taking interest-only mortgages too late, because how on earth are you going to actually have that property that you live in when you retire? Because it's, as we've mentioned before, it's somewhat difficult to get a normal repayment mortgage at those kind of ages. So that's something to consider, interest-only mortgages for your own personal home, and invest that money that you're saving into actually generating more money for you. I mean, I know lots of really smart people, they don't own their homes. They rent their home so they don't have to utilize all that money as a deposit, and they invest all that money in their businesses. And that's something that is quite popular actually in mainland Europe. In the UK here, people like to own their own homes, for whatever reason. I think it's a great thing. It's a great psychological thing, owning your own home and having that security. But actually, is it the smartest thing to do, return on investment wise? Maybe not. But that's a video. That's a topic for another video, shall we say? So just to recap, we've spoken about interest-only and repayment mortgages, and how most of the time buy-to-let investors will opt for interest-only mortgages, whereas if you're buying your own personal home, most often than not, it's going for a repayment mortgage. If you've got value or anything from today's video, please do let me know. I'd like to know if you're actually getting something from these so that I should continue them. And if you haven't already done so, I kindly ask that you consider subscribing to the channel. It really helps me, and it helps me push out more content. And before I sign off, oh no, the rainbow's gone. There was a lovely rainbow on the wingtip over there, but it's just gone now. Maybe I'll catch you another day. Take care.